This video is prepared to help students understand the concept of AS 19 leases. Let us look at an overview of the content covered in this video. Through this video, we are going to understand the meaning of lease in practical sense, learn about the parties involved, how to classify leases as financing or operating, and its accounting treatment in the books of both lessee and lessor. What is lease? Lease is an agreement which gives lessee the right to use an asset for an agreed period of time and for a payment. Let us understand the meaning with an example. Mr. A gives his milk van to Mr. B to use for a period of 8 years in return for a payment of Rs 50,000 per annum. This is a clear example of lease where Mr. A is the lessor who is the owner of the van and Mr. B is the lessee, the one who receives the right to use the van. Mr. B pays a lease rent of Rs 50,000 every year for 8 years in return for using the asset. Here we can call 8 years as the lease term. Classification of lease. Leases are broadly classified into two: financing lease and operating lease. The classification is based on the risk and rewards incidental to ownership of the asset. If the risk incidental to ownership lie with the lessee, it is called a finance lease, and if it is with the lessor, it is called an operating lease. Indicators of finance lease. Classification of lease depends on the substance of the transaction rather than its form. Hence, we should carefully interpret whether the lessee or lessor receives the maximum utility from the asset, irrespective of the ownership, to classify a lease as financing or operating. Let us learn one by one the indicators of finance lease. 1. Ownership of the asset is transferred to lessee at the end of lease term. In the lease agreement, there will be a clause stating the title of the asset will be transferred to lessee after the end of lease contract. The transfer of ownership at the end of lease term is automatic without any additional payment to lease. The best example is hire purchase. In case of hire purchase, ownership is automatically transferred after last installment is paid. Second, lessee has the option to purchase the asset at a price lower than fair value, and he is certain to opt for purchase at the inception, which means in the beginning of the lease agreement, lessor puts forward an option to lessee to purchase the asset at a lower rate after the lease term, and it is sure in the beginning of the lease contract that he will accept the purchase option. Third, at the inception of lease, present value of minimum lease payment is equal to or substantially covers the fair value of the leased asset. We need to find the present value of minimum lease payments and compare it with its fair value. We can understand this clause by doing some practical questions at the end of this video. 4. Lease term covers substantial period of economic life of the asset. This standard does not define the term substantial. It involves professional judgment, generally above 75% of economic life. For example, when a machinery having economic life of 8 years is leased out for a period of 7 years, we can say that the measure of economic life of the machine is covered in the lease agreement. Therefore, the machine is used by the lessee for a majority of its lifetime, even though ownership lies with the lessor. 5. Leased asset is of a specialized nature. It can be used only by the lessee without major modification. Others can use it only with major modification. For example, power plants, boilers, specialized pharmaceutical plants, etc. Generally, lessor builds these items at the premises of lessee and gives it for lease. In such situation, the asset is built to meet the specific need of lessee. These are the indicators that we need to check to classify a lease as operating or financing. If any one of them is satisfied, we call it a financing lease. Once we've identified the lease as financing, let us learn how to account it in the books of accounts of lessor and lessee. Starting with the books of lessee, the journal entry will be asset on lease account debtor to lessor. Here, we treat the lessor like a creditor and thus credited him in the journal entry. That's it. The journal entry looks really simple, isn't it? Now we need to find out the amount to be recorded in the above entry. Lease liability that the lessee should record in his books of accounts will be the lower of fair value of the asset at the inception of the lease and the present value of minimum lease payment from the viewpoint of lessee. In the books of lessor, the journal entry will be lessee account debtor to asset. The amount that we'll record in the entry is the net investment in lease. Net investment in lease is the present value of gross investment in lease. To record it in the books of lessor, we need to find out the gross investment in lease from the viewpoint of lessor. For lessor, gross investment in the lease is the aggregate of minimum lease payment from the viewpoint of the lessor, that is total lease rent, guaranteed residual value, and any unguaranteed residual value accruing to the lessor. Now let us do some practical questions to understand both of these concepts. In this question, the lease term is 4 years, the fair value is given as 20 lakhs and the lease rent paid every year is 6,25,000 and the guaranteed residual value is 1,25,000. In this question, the expected residual value is to be ignored because we don't consider it while calculating lessee's liability. It is only considered in lessor's lease rent calculation. As we learned earlier, lease liability will be the lower of present value of minimum lease payment and fair value. Here in the question, fair value given is rupees 20 lakh. Now we have to find the present value of minimum lease payment and compare it with 20 lakhs to figure out the lease liability. Take a look at this table. The column 1 shows the year, column 2 shows the minimum lease payment paid each year, third column shows present value at 15% and the last column shows the present value of minimum lease payments. For the first 4 years, as you can see in the table, minimum lease payment for each year is 6,25,000 and its present value rate is 2.855. Therefore, the present value of minimum lease payment for all the 4 years together will be 17,84,375. It has been said in the question that there is a guaranteed residual value of rupees 1,25,000. So the present value of guaranteed residual value in the 4th year is 71,475. So the total present value of minimum lease payment is 18,55,850. The fair value is definitely greater than the present value of all minimum lease payment. Therefore, the lease liability will be the lower of both, that is 18,55,850. Now let us do a question to understand how to calculate net investment in lease. In this question, the fair value of the machine is 48 lakh, lease term is 5 years, lease rental paid every year is 8 lakh, guaranteed residual value is 1,60,000, expected residual value is 3 lakh, internal rate of return is 15%. We need to calculate the net investment in lease and the unearned finance income. Let us start by calculating net investment in lease. Take a look at this table. Like the previous question, the column 1 shows the year, column 2 shows the minimum lease payment paid each year, third column shows present value at 15% and the last column shows the present value of minimum lease payments. For the first years, minimum lease payment for each year is 8 lakh and its present value rate is 3.3522. Therefore, the present value of minimum lease payment for all the 5 years together will be 26,81,760. There is a guaranteed residual value of rupees 1,60,000 and an unguaranteed residual value of 1,40,000. We had learned earlier that MLP from the viewpoint of lessor is the total of lease rent, guaranteed residual value and unguaranteed residual value. So the total of present value of minimum lease payment is 28,30,920. Therefore, the net investment in lease is 28,30,920. Now we'll move to the second part of the question. To calculate the unearned finance income, we need to find the difference between gross investment in lease and net investment in lease. Gross investment in lease will be the sum of 8 lakh of lease rent for 5 years, that is 40 lakh, and gross guaranteed residual value 1,60,000 and unguaranteed residual value 1,40,000. How did we find the unguaranteed residual value to be 1,40,000? Simple. Expected residual value comes into picture in such scenario. When guaranteed residual value and expected residual value is given, unguaranteed residual value will be the difference between expected residual value and guaranteed residual value. Here, 3 lakh minus 1,60,000 is equal to 1,40,000. So, at the end, we unearned finance income as 14,69,080. Now we are going to look into operating lease. Any lease other than financing lease is considered as an operating lease. That means if none of the indicators that we learned earlier is fulfilled, we can call it an operating lease. Lessee in his books of accounts will treat the lease payment as an expense in the statement of profit and loss account. In the books of lessor, leased asset is shown as fixed asset in the balance sheet and the lease income will be credited in the profit and loss account. With that, we have covered few basic concepts of lease as specified in Accounting Standard 19. Thank you.